Just want to make sure that the meeting is being recorded. So great. So just want to give everyone an opportunity to get in and get settled. Just want you to know that again, this is a great day to be together for us to learn a little bit more about how benefits, especially employee health insurance, is actually having an impact on organizations, and what we can do to maximize utilization, and also find out what are some ways to look at the process of renewal differently than we may have done so in the past. So today is not just a presentation about reducing benefits, and also it's not a conversation or a topic matter about negotiating harder at renewals. All those things are important in this context. However, I want us to not focus on reducing benefits. And I don't want us to focus on, well, I can negotiate harder because, I have an opportunity, or I know my broker, or I know we have, this number of employees. I want you to think about it in terms of the operating structure or architecture that you've been using, and also how that is having an impact on your organization. So specifically, this conversation is about how payroll and benefit utilization can be redesigned to convert fixed cost pressures into margin expansion. And that's what we're here to talk about today, because healthcare inflation is real. And I think the deeper issue that we are dealing with is how that cost behaves inside of your profit and loss statement. And so that's what we're going to be examining here today. So I want us to think about this and step back just for a second. All the things that we may know about healthcare and benefits and what's going on in the market, I want us to look at it from the perspective that we are redesigning payroll and benefit utilization architecture to convert fixed cost pressure into a variable margin, right? So we want to get that margin expansion to happen in a way that actually impacts the bottom line of an organization. And we do know that benefits are the mechanism. However, that the margin, meaning the profitability of the organization, is the objective. And so whether you are for-profit or nonprofit, at the end of the day, you're looking for a surplus of revenue over expenses in your organization. So if this conversation doesn't translate into an impact on your profitability, then we're not having a strategic conversation. We're just talking fluff, and that is something that we don't do in this session. So, got a question for you. Let me know if you can see that question. So the question is, what is your projected premium increase for this year? And I think it's important. To answer this question. I see that I may have done this a little bit wrong, but it's okay. We're gonna move on with it, right? So, what is your projected increase? Is it like just under 5%? Is that your projection? Somewhere between 5 and 10%? Or is it going to be, somewhere between 10 and 15%? Maybe over 15%. And then, some folks may, and again, it's okay if you don't know, if you're unsure about what that percentage would be, that's okay too. But if you're in a 10 to 15% or over, you're not alone. This is what we are seeing in the market today, and that this increase is not just something that's a one-time hit. It is something that's actually compounding every year that we go into this process of renewal. So the challenge is that premium inflation is outpacing revenue growth across most sectors. And I stated earlier, it's like it's not episodic, right? So it's not just this one time. It is something that's going to happen consistently. And so we need to be aware of what's going on in that arena. So I just want to give us an agenda for what we are going to cover today. We're going to cover, firstly, that there is an executive reality, right? And that's going to be that reality that, as prices increase and revenues are not increasing at the same rate by which some of our cost structures are, that we are having a pressure that's being put on the profitability of the organization. The second thing that we're going to talk about is the reframing of the financial questions. So too often when we're in this conversation, we just keep saying, well, how can I get better rates? How can I get better rates? We're going to talk a little bit about how we can change and shift that thought. And the third is I will introduce three structural levers that I believe have significant impact on how an organization can look at their benefit structure so that it actually benefits the organization and the employees. And then we're going to talk about profitability and the translation of that into a model that you could actually use based on where you are in your organization. And actually, it works whether you are in governmental organizations or agencies, or if you're in profit organizations, or if you're in nonprofit organizations, whether you're in service or a service or a professional service industry. It works across all industries and all organizations. And then the last thing we'll talk about is how, when you take all of those levers and you bring them together, that you begin to create an interactive model that gives you a way to make better decisions as a whole. So that's the agenda for today, and I know that we're going to have some fun while we're here, right? So let's get started. So the reality of an executive is this, right? And it's simple. Premium inflation is going to happen no matter what we do. The second issue that we're having with health insurance is claims volatility, right? So some years people are using them really heavily, other years they're not. However, what that does not necessarily translate into is the decreasing, especially in those years where premiums are used less. I'm sorry, where claims are used less. There's not a coinciding um, reduction premium costs. And the last one, or the third one we'll talk about, is labor sensitivity costs, right? So, especially in organizations that are heavy labor burden, and I don't mean burden in terms of they're on our nerves. I mean a burden in terms of that it requires a lot of people in order to get our jobs done. So in those environments, this is where we have to be mindful of what a change in employees mean on to the profitability of the organization, right? So if revenue grows at 4% and healthcare continue to grow at 12, 10, 13, 14, 20% in some cases, that compresses the margins that we would see in our organizations every year. It has a direct impact on the profitability of our organization. So this is just an example of what it looks like, right? On a graphical format, right? So, the gap between revenue growth and premium inflation continues to widen. So as you can see, we started this process and looking at this in 2019 and all the way through 2024. Next time I do this presentation, we'll see through 2025 because we will then have some more information regarding what that margin is. With that said, as you can see, that margin continues to widen. Or on average, organizations are seeing a 4% increase in revenue year over year. However, we're seeing over a 10% increase in healthcare insurance costs every year. That's a 6 percentage point difference in terms of what's happening within an organization. And again, without intervention, the margin compresses, right? So that's a pretty word. That just means you're making less money or your organization has less surplus to deal with. That's a reality of what's happening in the market today. So I don't see this as a benefit problem. I think it's more of an operating performance problem, right? So we have to start looking at things a little differently than we may have done so in the past. So I believe that there are three forces, right? So again, so Lisa, thank you for being here today, and I did not. I failed to mention you, and I apologize about that. So thanks for being here. If you have any questions, please put those in the chat box. Lisa's going to be assisting me throughout this process. So she will be able to answer some of your questions. Also, if you need to leave early, she's going to give you a link by which you can connect with me at any time after this meeting. So I want to talk to you about three forces that I believe that actually has an impact on your profitability as an organization, right? So the first one is premium inflation, which creates a fixed cost escalation. So short for that is as our health insurance costs increase, that becomes a fixed cost in the way that we operate our business. Then the next issue and the next thing that has a impact on your profitability is claims volatility. How are your employees using their health insurance plan, right? Are they going to the urgent care when they could have made an appointment with their general practitioner, or did they end up going to the emergency room when they could have gone to urgent care, or could they have just had a conversation with someone virtually and they could have gotten the same answer? So, how are they using their health insurance in a way that is actually most efficient and most effective for themselves as well as for the organization? And then the next part is about labor cost sensitivity. This increases with turnover, right? So the greater the turnover rate for an organization, the greater that labor cost sensitivity is, right? So the American Society for Human Resource Management estimate it costs about 40% of an employee's annual salary to replace that one employee. So imagine that if an employee makes $50,000, it is costing the organization almost $20,000 just to replace that one employee. That's on top of the salary that they're already that they're already paying the employee. So I mean, for me, that's an incredible number, right? So what I want us to understand is that each force independently has an impact on the profitability of the organization. And when you take all of these things that I've just talked about, the premium inflation, claims volatility, and labor costs, when you put those all together, I mean, you're talking about an issue that compounds significantly over time. So I don't want to belabor that point, but I just want to drive it home just a little bit. So before we go into this section, I just want us to take a moment to think about how can we reframe the question. Not so much about like how do I reduce my benefit costs or how do I reduce costs, because I think that question is the wrong question. I think the question that we should be looking at is one that says, how do we convert benefit spend into an operating leverage? And I think at this point it becomes more strategic in terms of how we are thinking about what happens in healthcare. So we're no longer just saying, well, what's my rate going to be this year? It's like, what are the things that are in place now that we can possibly control that helps us understand better and make better decisions around the benefits that we have in place in our organization. So there is the traditional view, right, of what happens in this process, right? So I'm going to negotiate harder. I'm going to shift some cost over to my employees. I'm going to reduce the plan's richness. And then I'm just going to accept the fact that, you know what, this junk is just going to hit my bottom line and we're just going to move on and we're going to try and drum up more business elsewhere, right? Not that any of those things are wrong. It is just that I think it's a traditional view of looking at health insurance increases, but I think there's a different way to look at it. It's like, instead of being, so dogmatic about it, what if we took a more curious approach? Like, what if we redesigned wage recharacterization to recapture that component, right? The redesign of the characterization, I'll talk a little bit more because it sounds a little bit, like a lot of words, but at the end of the day, what if there's a way that we can rethink about how we're paying our employees without changing their actual pay? Then the second part is, what if we can have a better understanding or help our employees have a better understanding of how what they're doing has an impact on the claims that they're making? And then what if we can stabilize our employees' attrition that's happening within our organization? My belief is that if we can do those things, and then how can they, in fact, impact the earnings of the organization? So that's the shift that I'm talking about today. That's a little bit different than maybe what you have seen in some of your conversations of the past. So there are three independent financial levers that are impacted by the work that we are doing with regards to health insurance. And that is we believe that these levers, the payroll tax change, right? I don't want you to get mixed up with that. So the model is if we can change what the taxable payroll income is, then we can have an impact on the bottom line of an organization. Second is if we can find a way to shift and have our employees better utilize their health insurance, we also have another way to possibly reduce our increases year over year. And then the third is if we can help ensure that we're keeping more folks in our buildings and in our companies who are shifting less out of our organizations, we have the ability to keep some of the institutional knowledge that's there without always having to go out and look for another a new employee. And I believe that each model, each one of these can be, not I believe, each one of these can be modeled. And together we will talk about how they compound so that we can see a true impact on an organization. So, what I'm going to talk about here is the payroll tax delta model. So, every taxable wage dollar generates about a 7.65% employer FICA tax burden. That's an obligation that an organization cannot get out of. So every time we pay an employee a dollar, 7.65 cents goes to FICA. When wages are recharacterized through compliant pre-tax elections, the taxable base declines, right? So if I paid someone $100, but their taxable wage is $50, I am not paying $7.65. I am now paying $3.82.5 on that. So it actually reduces my tax obligation as an employer. So again, this is not a credit. It's about being structural in the wage efficiency. How do we better use it? So here's the formula for it, right? Characterized wage equals the number of employees that you have times those that are participating in the program times the average election, right? So the election in our program is about $14,000 per year per employee. So that equals the employer FICA tax savings, which is the recharacterization of wages times 7.65%. So what I would have paid in wages versus, I'm sorry, what I would have paid in taxable wages versus what I ended up paying in taxable wages, that becomes the savings of the organization. So what we're talking about here, and again, this is no sleight of hand, this is no magic trick. This is about taking the information that we already have within our organizations and making them work for us in everything that we're doing. So here's another part I talked to you about before. This is the payroll tax delta, right? So this shows you just an example of what it looks like. So recharacterize wages equals employees times participation times election, right? So we talked about that already. This repeats every payroll cycle. So here's the part, and this is where I get a little, and I'm just going to call it. I get a little snippy sometimes with folks because they're like, "Well, I'll wait and see how it works." In 5 years. Well, let me see. If you're paying $1 million in payroll, no, let me use a different number. If you're paying $100,000 in payroll, and I could show you how to save $30,000 a year, right? That's just under $3,000 a month. Every time you wait on saying this can work for me, you are giving away $3,000 of earnings in your organization. Little money for some, big money for others, right? So if you have $1 million payroll, that number expands. In this example, this organization had 100 employees. 70% of their employees participated in the program. They had an annual election rate of about $4,000, right? That's per employee. And so with that $4,000, they were able to recharacterize just over $250,000 in wages. And then again, the FICA tax rate does not change. So they were able to have an annual impact on their actual outflow of dollars of $21,400. Therefore, they were able to save just over $306 per employee in that 1 year. That's incredible in terms of what this means for that, what it meant for that organization. So Again, this becomes recurring because participation becomes a controllable financial lever, right? The more employees that participate, the better it is for the organization. So here's another one. So each participating employee generates $306 annually. That number is about how the organization is able to save or reduce its outflow of cash. Now, if you're like me and running my organization, every dollar matters. I don't want to give away anything more than I have to when paying my taxes, right? I know I have to pay them, but the question is, how am I going to pay them, right? So this gives you a graphical representation of what it looks like as the organization grows in size and the participation rate increases. The annual savings in FICA, the tax, if goes up to about 80%, you see about a $26,000 increase savings in FICA tax. So that's something that I wanted to take. So at 500 at 500 or 1,000 employees, this becomes really material and it really expands in terms of what happens over time. So participation is not a human resources metric. It becomes a financial input. So here's another question, right? So let's see the second question. I see some of you have gone ahead. I appreciate that. That was my error. I put the question out there before I even got there. Would participation as a financial lever change your viewpoint of benefit? And most of you said yes. Some of you said no. And one person said they want modeling, right? I mean, in these questions, I mean, there's really no right or wrong answer because it's really about getting an understanding of where things are. So, executives make decisions based on model exposure and not on assumptions. So, what this gives you as you're moving through is just a way of having a different kind of conversation that's actually more high level, especially when time is tight and you need to really get to the point of the issue. So claims impact sensitivity model. So remember, I told you there's three models. We're gonna walk through each one of them, right? So the claims sensitivity model applies as a conservative band of 2 to 6% to total claim spend, right? So basically, this means if you can reduce your claim spend or the claims that are used 2 to 6%, what would it mean for your organization, right? So this no longer becomes just a baseless projection. It becomes an analysis that you can use or a lever that you can use in making a decision about how you move forward with your benefits as an organization. So the question is simple. If claims behavior shift modestly, what is the financial exposure of the organization? And I think that becomes critically important in terms of how we are moving this model forward because it is about these things compounding time over time. So let me work through or give you an example of what this looks like. So claim sensitivity. In this organization, they have about $5 million in claims. If they were able to shift, right, modestly, a 3% in terms of how employees are using their health insurance, that would equal to about $150,000 in savings, right? So as you can see in the band here, you can see if they shift by 2%, it could end up being a $100,000. If they shift by 6%, it could be a $300,000 reduction in their claim spend year over year, which will potentially have an impact on the bottom line of the organization, right? We can't make a promise, but we can tell you this is something that you can look at that says that if you reviewed it this way, you have a better chance of understanding how this could have an impact on your organization. So this is what it looks like. The next one is the retention stabilization component, right? Turnover is a labor cost problem that's often disguised as human resources issue. I like to believe that every time someone leaves an organization, they're not leaving human resources. They're leaving their bosses. They're leaving their managers. They're leaving the people who are directly overseeing them. So every departure triggers recruiting, then onboarding, and productivity loss. Right. So, I mean, I think we may all agree that that's sort of the way it goes, right? We lose a person, we have to go out and find one. Then we have to onboard them. And then we have to get them up to snuff so that they can become as productive as the person that they replace or more productive than the person they replace. So you're losing productivity along the way. So even the modest stabilization produces measurable financial impact. And I'm going to show you what that looks like. Actually, you can see it here. So if you have 500 employees, you have a 2% reduction in the turnover rate in your organization. And let's say it cost about $8,000 to replace each employee, right? So let's say in this scenario, the person makes about $40,000. So if it cost about $8,000 to replace one employee, the annual impact is about $80,000 for this organization just to replace, um, just to replace those employees that have left the organization, or they're saving $80,000 by not losing 2% of their workforce every year, right? So if they had 15% turnover, we're able to reduce that by 2%. This is what their savings would be. So th sorry, this is what it looks like. So if you have 100 employees and you were able to reduce your retention costs, whether you have 500 employees or if you have 1,000 employees, this is the savings that you will see within your organization based on on 1, 2, and 3% reduction in attrition at your organization. So the great part is now we get to have another conversation. Let's see, did anybody go long? All right, so which lever do you think presents the greatest opportunity? Is it the claim sensitivity? Is it retention stabilization? And again, whatever your response was, it's really there is no right answer, right? Because when we say that things are compounding, it means that everything has an impact on the bottom line. So whichever lever you chose, it could have that impact on the organization. And again, if you're not sure, again, this is not about me or us trying to prove how smart we are or you are or not. This is really just saying like, where do these things lie in the work that we're doing? So, because at the end of the day, what I believe is that everything that we do in an organization has an impact on its profitability, right? So you see that EBITDA there, that's all about your earnings before whatever, right? All the other stuff that that you gotta take out before you can say, yes, we've actually made profit in our organization. So the combined impact is the example. In this example, is like $250,000, $254,000. That's on a $2 million earnings. That's a 12% margin improvement over where you were before. So that's where it becomes in terms of like the impact on the organization. So as you can see, we had a change in payroll, right? So that change in payroll netted us about $25,000. That was just a change in taxes that we're paying. Then we had a 3%, right? So we like to stay modest, right? There's a 3% reduction in claims costs, right? So our employees are using the health insurance better than they were before. Then we had another modest change in terms of the number of employees leaving our organization, right? 2 to 3%. And the cost of that was also noted here. So when you add these all together, you begin to look at $250,000 of savings within an organization over time. So we're talking about payroll, the change in payroll tax, that change in payroll taxes. Then we talked about the claim sensitivity, and then we talked about the retention stabilization. And when you add those together, it has measurable impact on the profitability of an organization. So as you can see here, $251,000 They had a baseline earnings before the redesign of $2 million. With this change, they have seen a 12.5% improvement in their overall revenue without increasing their revenue. I'm sorry, in their overall profitability without increasing their revenue. So now, if we can look at multiple measures, we can then have a better conversation with our leaders around what we need to do. So I said a lot, but I was really trying to get to is that, if your premium increase is $150,000, how many participants are required to offset it? So in this model, it states that 4,000 dollars is if $4,000 is the election average, and you multiply that times the 7.65%, we know that that $306 per employee that's participating in the program. So then when we divide the $150,000 as that target increase in premium, and that by $306, that means that 490 of our employees need to participate in the program. If we are an organization with 1,000 employees, in order to overcome that, right, we need 490 to participate. Then we need another 210 employees to participate, so that it actually shows us that we can actually make this work. So at 80 participation, we would have about 613 employees participating in the program, which then makes this calculation really feasible for an organization to do well and to see that benefits are just not something that just sits out there and that we have to deal with every year, but we can then start modeling it so that it begins to make sense for the organization as a whole. So let's think like an executive does. We think in terms of ranges, right? There's conservative, there's moderate, and then there's optimized. So even the conservative scenario in this model exceeds $150,000. The optimized scenario approaches $500,000. So again, we don't promise outcomes. We try to model defensible ranges so that when we're having conversations, we can then say these are the things we need to do as an organization in order to provide the kind of structure that our organization needs to improve its profitability, also to stabilize our employee pool, and then also to maximize our employees' understanding of how they utilize their health insurance benefit. So the next step is let's model your margin, right? So this is it's just a step. And again, this is not a sales conversation. It's a 30-minute strategic modeling session where we will build out a conservative and moderate and optimized scenario using your actual headcount, your claims data, and your participation assumptions. What you would leave with is a decision-ready financial framework. You can schedule it directly at Manoa Solutions/get EHP. Again, that's Manoa Solution/get EHP. So Lisa, if you could put that in the chat box, I would appreciate it. So that we can get folks onto a call. Also, Lisa's put my phone number here, and again, I'm available. This is not some secret sauce or anything. This is something that I'm willing to share with you, so that you can make better decisions within your organization. Again, we build a conservative, moderate, and optimized scenario using your information so that you lead the decision with with a financial framework that's ready for you and your organization. So you have a few choices to make. I will close with one question. What would prevent this from being implemented in your organization? Because I don't think this is not about handling or me trying to force you into a conversation. It's about identifying variables that must be modeled. So are there any questions? You can take yourself off of mute, ask any questions that you would like, and do you the honors here today to answer them to the best of my ability. So, as of one clear thought, premium pressure will continue, claims volatility will continue, and labor cost sensitivity will continue. The question is not whether those forces exist. The question is whether they remain fixed as a fixed cost pressure or whether you convert them into controllable operating variables. Today, we did not discuss reducing benefits. We discussed redesigning the architecture that we use to understand the benefits that we have. We talked about payroll tax efficiency. We talked about claim sensitivity, and we talked about retention stabilization. So individually, each lever is measurable. Combined, they create and materially impact the profitability of your organization. So these are not incremental savings. This is a structural margin expansion, right? So this is how do we provide greater margin for your organization. For leaders in the room, the responsibility is not to react at renewal, is to engineer predictability inside the income statement of your organization. If your healthcare costs are rising anyway, you should at least understand your controllable levers. Model the exposure, examine the ranges, and make decisions from a position of financial clarity, not one from emotion or from assumptions. And if the math does not justify the effort, you shouldn't do it. But if it does, then this becomes less about benefits and more about enterprise performance. That is the lens I encourage you to take with you. So thank you for being here, taking the time out of your day. Have a great rest of your week, and I will see you on the next time. Y'all take care.